U.S. stocks have been surging since the election with
The gains since Election Day have been historic, and
After Donald Trump took office, it seemed as if the stock market was skyrocketing, or at least celebrating.
Do you view that as a report card for the
Absolutely.
administration?
Absolutely.
Trump's Treasury Secretary Steven Mnuchin proclaimed it was a sign of confidence in the administration's proposals. But research by Chicago Booth's Lubos and Pietro Veronesi indicates that betting on Trump for high stock market returns may be misguided. To understand why, we need to look back at returns under previous administrations.
Stock returns under Democrats have been about 11% higher on average than stock returns under Republicans. 11% per year. I mean, that's huge.
Upon hearing that statistic, you might think that Democrats are good for the stock market and Republicans are bad for the stock market. But the researchers find that that's not the case.
It's about when they get elected. So Democrats tend to get elected when people are highly risk averse, such as during crises. Republicans tend to get elected when people are less risk averse, such as when the economy is strong, when people are prosperous.
Here's how their theory plays out. The economy goes through cycles, and these cycles affect voting patterns. When the economy stagnates or declines, people are more reluctant to take on business risk. Stock valuations are low, although future returns are expected to be high. In this environment, voters tend to elect Democrats, who benefit from the growth that follows. Think of Obama's victory in 2008. He was sworn in just a month and a half before the stock market hit the lowest point of the financial crisis. Then the market rebounded.
So if George W. Bush were magically installed as president for another 8 years after 2008, chances are returns under him would have been high. However, that's not what happens. We have a democracy. We decide who to put in, and in 2008, voters put in a Democrat because of the crisis. See, when people are more risk-averse, they demand more social insurance, more redistribution, a stronger social safety net. And that's more likely to be provided by Democrats. Whereas when people are less risk-averse, they're more willing to take business risk, they demand less social insurance, so they're less likely to vote Democrat and more likely to vote Republican.
So if you're wondering how your stocks will fare during Trump's tenure, things get a little bit tricky.
Trump won his election by a narrow margin. In fact, you may recall he won the electoral vote, he actually lost the popular vote. So when the election outcome is this close, risk aversion is likely to be neither particularly high nor particularly low. And in an environment like that, the channels we emphasize are not the driving force behind future returns. So I think the returns during Trump's presidency will have less to do with risk aversion and more to do with his actual policies, what policies he manages to push through, and how successful those policies will turn out to be.